I'd like to ask you, Ryan Gibson, what is the biggest risk?
Yeah, so I would say your biggest risks are external threats. Things like cap rate expansion, property values declining. You really can't control that. Interest rate risk, et cetera. But I would say my focus that I'd like to share is five main things that I look at in underwriting a deal. And I can do this in 10 seconds. I look at revenue growth year over year, and is it reasonable? Does the business plan identify if that revenue is achievable based on the market study that you've done, somebody else has done, or an operator's done? The second thing I look at is insurance. So insurance costs are not going down. So if you have not pro forma'd that your insurance expenses are going up, I usually don't like the deal anymore as much. The second thing that I assess risk, or the third thing, is property taxes. Property taxes are not going down. Property taxes are going up. And if you're not planning on property taxes at least doubling over a 5-year hold period, I don't think we've assessed the risk and the opportunity. The third thing I look at is expense to gross, or revenue to expense income. So EGI, expense to gross income ratio, I guess is another way of saying it, EGI. That's if you make $1 of revenue, what percentage will be your operating expenses? And so in self-storage, I'll look at a deal and I'll say, I expect to see between 35 and 40% expense to gross income ratio, meaning that if you're collecting $1, I expect to see 35 to 40 cents for that dollar in expenses and all your utilities, insurance, property taxes, all that stuff before debt service. If I see that number 20% or 15%, I don't think there's been enough assessment in the underwriting to really accurately depict the worthiness of that deal. And the last thing I look at is cap rate, because cap rate, everybody loves to think that they're the best operator, or they have secrets and things like that. But at the end of the day, cap rates drive the value. They drive the value. They drive the exit strategy. The market really drives where a lot of these assets can perform. And yeah, we can control and do our best, but that cap rate really makes an impact. I mean, $1 on a 6% cap rate means $15 of valuation. So yes, operating income can do that, but I like to see an investment where you can stress test it and that you can actually show the cap rate getting worse than what you bought it for. Not from your operations, but just market cap rate. So if you buy something going in cap rate at 5%, in today's market, I'd like to see that it can exit at a market cap rate of 6% and still be profitable. So when I assess risk, I look at those 5 things in underwriting, and I really kind of stick to my guns on that. That's how I can look at a deal and in 30 seconds know, have they adequately assessed the risk? Of course, there's tons of more things that you need to do beyond that, but those are kind of my 5 quick check boxes on any opportunity.